Hello everyone. Today we are going to discuss a very practical topic, that is accounting for a national disaster. My friends, before we dive into the technical accounting aspects, let me ask you something. Have you ever seen the news about earthquakes, floods, hurricanes or tsunamis? These natural disasters can destroy entire cities. They can destroy communities and cause massive sufferings. We have all seen the heartbreaking images on televisions and social media, right? But today, we are not just talking about the human impact. We are going to discuss how these natural disasters affect businesses and, more importantly, how companies account for these disasters in their financial statements. My friends, natural disasters are not just humanitarian crises, they are also major financial reporting events, like when a factory gets destroyed by an earthquake, or when an inventory gets damaged by floods, or when a customer cannot pay because their business is destroyed. All of these have accounting implications. So let's understand how to account for natural disasters properly, step by step. First of all, let's define what we mean by a natural disaster. A natural disaster is any hurricane, tornado, storm, flood, high water, tidal wave, earthquake, landslide, mudslide, fire, explosion, or other catastrophe that results in substantial damage to property, hardship, sufferings, or possible loss of life. My friends, in recent years, we have seen so many devastating natural disasters around the world, like bushfires in US and Australia, or earthquakes or massive monsoon rains in different countries of the world. And of course, the COVID-19 pandemic, which we can also classify as a natural disaster. All of these events had massive impact on businesses operating in those areas. And when businesses are affected, their financial statements are affected too. Now, before we get into the details of specific accounting issues, let me explain one very important principle about timing. Generally speaking, the losses from a natural disaster will be reflected in the accounting period when the natural disaster occurred, regardless of when you receive any compensation or insurance claim. What does this mean? Let me give you an example. Let's say there is a company called XYZ Limited with a year end of 31st December 2024. On 15 November 2024, a massive earthquake hits the area where the company operates. The earthquake destroys some of the company's building and damages a lot of inventory. Now, XYZ Limited has insurance and they file a claim immediately. But the insurance company is taking time to assess the claim. And by 31st December 2024, XYZ Limited has still not received any compensation. Now, in this case, XYZ should recognize the loss from the earthquake in the year 2024 when the disaster occurred. But the insurance compensation will be accounted for separately and only when it becomes certain and receivable. So losses and compensations are accounted for separately. Don't mix them up. My friends, before we go into the specific accounting issues, there is one more timing issue we need to clarify. So pay attention. What if the natural disaster occurs after the year end, but before the financial statements are authorized for issue? Now, in this case, we need to apply IAS 10, events after the reporting period. Under IAS 10, we have two types of events. One is adjusting event that provide evidence of conditions that existed at the reporting date. And the other is non-adjusting events that are indicative of condition that arose after the reporting date. Now, If a natural disaster occurs after the year end, it is generally a non-adjusting event because the disaster did not exist at the reporting date. The conditions that caused the disaster arose after the year end. So you don't just adjust your financial statements for it, but you need to disclose it in the notes if it is material. Let's say EBC Limited has a year end of 31st December 2024. The financial statements are authorized for issue on 28 February 2025. On 15 January 2025, a massive flood destroys one of the ABC's factories. In this case, the flood is a non-adjusting event because it occurred after the year end. EBC will not adjust its financial statements for the year ended 31st December 2024 for this flood. But because this event is material, EBC will disclose this event in the notes to the financial statements. However, sometimes it's not so straightforward. My friends, sometimes the natural disaster spans the year end date. For example, a hurricane might start before the year end and continue after the year end. Now, in such case, you need to carefully assess which portion of the loss relate to the pre-year end period and which portion relate to the post-year end period. It means if the event spans the year end date, it may not always be straightforward to determine whether the event is adjusting or non-adjusting. Okay, now let's discuss the various accounting issues that arise when a natural disaster occurs during the accounting period. We are going to cover multiple areas one by one. My friends, this is probably the most obvious and most significant impact of a natural disaster. That is, impairment of non-current assets. When an earthquake hits, or when a flood strikes, or when a fire breaks out, assets get damaged or destroyed. Now let's understand how to account for this. In case if an asset is destroyed completely or it is lost, it's simple. You derecognize the asset immediately. You remove it from your books. The building is written off, the asset is written off as an expense in the profit and loss statement. Simple. But in case if the asset is damaged but not completely destroyed, what if it can still be used but its value has declined? In this case, you need to perform an impairment test under IS 36, that is impairment of assets. Now listen to me carefully. A natural disaster is a very clear indicator of impairment. When a natural disaster occurs, even if you don't see immediate physical damage to your assets, the economic environment has changed significantly. Customer demand might have declined and your future cash flows are likely to affect it. So a natural disaster triggers the need for impairment testing. When you perform the impairment test, you calculate the recoverable amount of the asset, which is the higher of fair value less cost to sell or value in use. And if the recoverable amount is less than the carrying amount, you recognize an impairment loss. Let's say we have a factory with a carrying amount of $5 million. A flood damages the factory, but it is not completely destroyed. We perform an impairment test and determine that the recoverable amount is $3.5 million. Now, we need to recognize an impairment loss of $1.5 million by debiting the impairment loss in profit and loss and crediting the factory or the accumulated impairment. Also, my friends, don't forget about goodwill and intangible assets. Under IS 36, goodwill and intangible assets with indefinite useful lives are tested for impairment annually. But if there is any indication of impairment during the year, like the natural disaster, you need to test them immediately. Why? Because a natural disaster could significantly affect the future profitability of your business. if cash flows are expected to decline, your goodwill might be impaired. Okay, now, it's not just non-current assets that get affected. Current assets can also be impaired. Imagine you are running a textile business and you have a warehouse full of fabrics. A flood hits and the water damages a lot of your inventory. Under IS2 inventories are measured at lower of cost and net realizable value, that is NRV. So if your inventory is damaged by a natural disaster, its NRV might be lower than its cost. Now you need to write it down. Also, after a natural disaster, your customers might be in a financial trouble. Their businesses might be destroyed. They might not have cash and they might not be able to pay you. So you need to reassess your expected credit losses, that is ECL, under IFRS 9 financial instruments. Under IFRS 9, if there is a significant increase in credit risk, you need to increase your loss allowances for receivables. A natural disaster is a clear indicator that credit risk has increased. So you need to review your receivables and increase your loss allowance if it is required. My friends, let's now talk about the good news. Many businesses, especially those located in high risk areas, maintain insurance to protect themselves against natural disaster. So when a natural disaster occurs, the company will file an insurance claim. Here the question is, when do we recognize the insurance compensation in our financial statements? Under IS 37, that is provisions, contingent liabilities and contingent assets, you can only recognize an asset from an insurance claim if receipts is virtually certain. Listen to me carefully. Virtually certain is a very high threshold. It's higher than probable or likely. It means there is almost no doubt that you will receive the compensation. So in most cases, when you first file an insurance claim after a natural disaster, you cannot recognize the insurance compensation as an asset or an income because receipt is not virtually certain yet. However, if receipt is probable but not virtually certain, you can disclose a contingent asset in the notes to the financial statements. Let's say ABC Limited's factory is destroyed by an earthquake. The carrying amount of the factory was $10 million and ABC has insurance and files a claim for $10 million. On 31st December 2024, that is year end, ABC Insurance Company is still assessing the claim. The insurance company has indicated that the claim looks valid, but they have not confirmed the amount yet. Now in this case, ABC Limited must have to recognize the loss against the destruction of factory by debiting the loss on destruction of asset in profit and loss by $10 million and crediting the factory by the $10 million by the same amount. But for insurance compensation, the company should assess the compensation. Is receipt of insurance compensation virtually certain? Probably not, because the insurance company is still assessing. Is receipt probable? Maybe yes, if the insurance company has indicated that the claim looks valid. So ABC Limited should disclose a contingent assets in the notes to the financial statements, but not recognize the insurance compensation as an income or as an asset. Later, if and when receipts become virtually certain, for example, the insurance company confirms that they will pay, then ABC Limited can recognize the insurance compensation. My friends, listen to me very carefully. This is very important. Best practice is to not net off the asset impairment and the insurance compensation. What does this mean? It means you should show the loss separately and the insurance compensation separately in your profit and loss statement. Don't just show the net amount, because this gives users of the financial statement more information. They can see the gross impact of the natural disaster and the gross amount of the insurance recovered. For example, if your building worth $10 million is destroyed and you receive insurance compensation of $8 million, you should show loss on destruction of building of $10 million as an expense and insurance compensation received of $8 million as an income. Don't just show a net loss of $2 million. Show them separately. Sometimes, after a natural disaster, the government might provide grants or financial assistance to the affected businesses. You need to account for these government grants under IAS 20, that is accounting for government grant and disclosure of government assistance. But be careful. Government grant often come with conditions attached. After a disaster, you need to check whether those conditions are still being met. For example, a government grant might require you to maintain a certain level of employment or to continue operating in a specific location. If the natural disaster has affected your ability to meet these conditions, you might need to repay the grant. So review your government grants carefully after a natural disaster. Okay, now let's talk about provisions. After a natural disaster, several types of provisions might arise. For example, natural disasters can result in environmental damage. For example, an earthquake might cause oil or gas spills. A flood might cause chemical leaks. A hurricane might damage industrial facilities, causing pollution. If your company is responsible for cleaning up or restoring the environment, you need to recognize a provision under IAS 37. Now, determining environmental liabilities is typically an ongoing process. You might not know the total liability immediately, but that's okay. IAS 37 says you should recognize cost as they become estimable, even if you don't know the total liability yet. So as you get more information about the environmental damage, you update your provision accordingly. Also, after a natural disaster, management might make some difficult decisions like selling or terminating a line of business, closing business activities in a particular location, relocating the business to a safer area, or laying off employees to cut their cost. If management decides to restructure the business, you might need to recognize a restructuring provision under IAS 37. But remember, the criteria for recognizing a provision under IAS 37. You can only recognize a provision if there is a present obligation from a past event, outflow of economic benefit is probable, and the amount can be estimated reliably. So for a restructuring provision specifically, IAS 37 says you have a present obligation only if you have a detailed formal restructuring plan and you have raised a valid expectation in those affected that you will carry out the restructuring. For example, by publicly announcing the plan or starting to implement it. So you cannot just recognize a restructuring provision because management is thinking about restructuring. There has to be a commitment. Now, when measuring the provision, only include the direct cost of restructuring, such as employee redundancy cost, lease termination penalties, and direct cost of closing facilities. Must remember, do not include future operating losses, cost of retraining or relocating continuing employees, or marketing or advertising cost for the new structure. My friends, this is very important. You cannot recognize provision for future operating losses, as these are not liabilities under IAS 37. You cannot recognize provision for future repair cost, unless there is a present obligation. And also you cannot recognize provision for general cleanup cost unless there is a specific obligation. The reason is there is no present obligation from a past event. A natural disaster might mean your business will incur losses in the future, but that does not create a liability today. Future losses are not your liabilities. Similarly, if you are planning to clean up or repair things in the future, but there is no legal or constructive obligation, you cannot recognize a provision. Alright, let's talk about decommissioning provisions. If you have already decommissioning provisions recognized, for example, obligation to decommission an asset at the end of its life and restore the land, you might need to review them after a natural disaster. It is possible that the natural disaster might change the timing of the cash flows or the amount of the cash flows. Maybe you need to decommission earlier now, or maybe more work is needed now. So review your existing decommissioning provisions and update them if necessary. My friends, after a natural disaster, some of your contracts might also become onerous contracts under IS 37. We already know that onerous contract is a contract where the unavoidable cost of meeting the obligation exceeds the economic benefits expected to be received. For example, you might have a supply contract to deliver goods, but your factory is destroyed and you cannot manufacture the goods anymore. Now, the cost of fulfilling the contract now might exceed the benefits. In such case, you need to recognize the provision for the onerous contract. However, many contracts contain force majeure clauses. These are clauses that allow parties to terminate or suspend the contract without penalty if there is an unforeseeable event beyond their control, like the natural disaster. So check your contracts. If there is a force majeure clauses, you might be able to terminate the contract without incurring a penalty, in which case you don't need a provision. Okay, now let's talk about deferred tax. This is a bit technical, but stay with me. Under IS 12 income taxes, deferred tax assets are recognized only if it is probable that future taxable profits will be available against which the deductible temporary differences can be utilized. Now, after a natural disaster, your estimate of future taxable profits might change significantly because the natural disaster might reduce your revenue in the future, increase your cost, or affect your business operations for the years to come. If you now believe that future taxable profits will be lower, you might not be able to recognize some of your deferred tax assets anymore. So after a natural disaster, review your deferred tax assets and assess whether they are still recoverable or not. And this could result in a deferred tax expense in the profit and loss statement. My friends, this is a very serious issue. Listen to me very carefully. After a major natural disaster, some companies might face such severe difficulties that their ability to continue as a going concern is in doubt. Now, what does going concern mean? It means the company can continue its operation for the foreseeable future, at least 12 months from the reporting date. After a natural disaster, several factors might threaten going concern, like significant assets are destroyed, revenue is severely impacted, the company faces liquidity problems, loan covenants are breached, suppliers refuse to supply on credits, or key customers are lost. So if there are material uncertainties relating to going concern, you are required to disclose them. And if the going concern assumption is not appropriate at all, then you need to prepare the financial statement on a different basis. that is liquidation basis, and disclose this fact. This is very serious, my friends. Going concern issues need to be carefully assessed and disclosed. Okay, now let's talk about another practical issue that arise after the natural disasters: debt covenants. Many companies have loans from banks, and these loans often have covenants attached. These covenants are conditions you must meet, such as maintaining a minimum current ratio, maintaining a maximum debt to equity ratio, maintaining minimum net worth, or not breaching certain financial thresholds. Now, after a natural disaster, your financial position might deteriorate so much that you breach these covenants. For example, your assets are impaired, reducing your net worth, your losses increases, reducing your equity, or your cash flow is disrupting, all these affecting your liquidity ratios. So if you breach a debt covenant, the loan might become repayable on demand. In this case, under IFRS 18, you need to reclassify the liability as current, even if the lender agrees after the year end but before the financial statements are authorized, not to demand the immediate payment. This is important because reclassifying the liability as current could worsen your current ratio further, trigger breaches of other covenants, and create a domino effect. So after a natural disaster, companies need to assess whether any covenants are breached, communicate with lenders, try to renegotiate covenants before the year end if possible, and properly classify liabilities in their financial statements. Are we clear on that? Debt covenants can be a major issue after the natural disaster. My friends, all of the issues we have discussed involve significant judgment and significant estimates. And when there is a significant judgment involved, you need to provide additional disclosures. So after a natural disaster, you will likely need extensive disclosures in the notes to the financial statements explaining everything. These disclosures are crucial for users to understand the full impact of the natural disaster on your business. Alright, my friends, we have covered a lot today. This is accounting for natural disasters. It is a complex topic with many different accounting issues. But if you understand the principles, you can handle it. I hope I would have been able to explain all these concepts clearly in our today's discussion. Natural disasters are tragic events, but as accountants, we need to ensure that their financial impact is properly reflected in the financial statements. We will conclude today's conversation here. Thank you for watching.